Hello and welcome to 52 Weeks. This week we're going to continue the discussion of Chapter 5, Housing, and in this chapter I've split it up into 6 segments to make it a little bit easier to digest. That was looking at the introduction, number 2, the building typology, number 3, building statistics, number 4, issues in housing, number 5, observations, and number 6, building blocks of Harrisburg. This segment is going to be looking at appreciation, and in the comp plan is talking about how do we look at appreciation and our valuation of an entire city from the individual parcel or property to the entire city. So the question first is, what is appreciation? When an asset's value increases over time, this happens because of changes in housing, supply or demand, changes in inflation, and changes in interest rates. So this is important to understand. If you follow this, we want to try to appreciate at a rate that is not terribly fast. We look at our houses when we buy into them or borrow this. There's a long-term investment that's there. To be honest, that's what people are looking at property, and that's where, when you look at overall how people have generated wealth, that's where that's come from. The opposite of that is depreciation, and that's when the asset's value decreases over time. That makes sense, is that is also affected by the supply and demand, inflation, and interest rates. The neighborhood scout data shows that was in the comp plan shows the appreciation rates for home in Harrisburg have been tracking above average for the last 10 years. So this is a good sign that they're in the positive as they're appreciating well. The cumulative appreciation rate, as it was calculated within the comp plan, that over 10 years it was 28.78%, and that's 2.56 annually. Harrisburg is in the top 30% nationwide, and the national average is at 6.7%. What does this mean as numbers? The comp plan tries to break this down a little bit, looking at it in terms of affordability. It is important to keep an eye on the appreciation rates as nationally housing costs have outpaced wages. This affects who can afford to own. So this goes back to the previous segment we just talked about. As these rates continue to climb, is that the housing affordability becomes an issue. The HUD area median family income, that's the HAMFI, Harrisburg Carlisle metropolitan statistical area, is at $75,200. So that's your mean family income when they take the entire metropolitan statistical area. This is not just Harrisburg City. So with regards to this idea of housing affordability, from the January HousingWire.com article, Pullman was quoted in this. He concluded that with the rental affordability outpacing home affordability in the majority of the U.S. housing markets and home prices rising faster than rental rates, the American dream of owning a home may just be that, a dream. These are questions that we need to discuss and figure out. So in this information society that we have, we can track and look at the data and try to adjust as necessary. But we are behind in this. And so nationally, we look at these problems that we're going to begin to have into the next decade. Continuing that same article, it states that home prices are outpacing wages in 80% of the counties in the U.S. So this should be something of concern, everywhere. And as this data continues to be looked at. And returning back into the comp plan, appreciation offers an opportunity to reset valuation, bringing underwater properties back into balance and creating equity value in the property to provide collateral for home improvement. So these are the things that the comp plan was looking at. How do we rebuild this equity? Policies promoting appreciation encourage the emergence of an equity pool for the city to leverage to address the deferred maintenance. This would unleash a virtuous cycle of reappraisal and increased valuation. Calculations in the comp plan, assuming that we have 25,000 units at a median value of $87,000. The city's housing stock is valued at approximately $1.75 billion. Producing equity to leverage the $250 million to $350 million of deferred maintenance could be leveraged with a 14% appreciation in housing values. So this starts to begin to address how do we pick up the cost of deferred maintenance. So how do we address that is implementing a suite of policies that accelerate and capture appreciation to the city's historic building stock is the single most transformative tool available to the city. As the comp plan states, this is readily achievable through the application of policy or by simply waiting for 5 years. So we have these two options. Question then is asked in the comp plan, can we actually wait those 5 years? Unfortunately, using the waiting method, costs of improvements will also appreciate. The policy initiatives that can aid this process is looking at streetscape improvement, focused on that from Chapter 4, understanding the effort of apprentice crews that are going out working to help rebuild and fix, and that's a whole other discussion to happen in building up the trades, and also landscape maintenance, etc. Though these things are somewhat happening when we look at CRW and the crews that are going out, particularly for infrastructure. Question is, who's going to be maintaining the green infrastructure on 3rd Street? All of these types of crews, how do we start to build that and looking at long-term growth? Switching gears in this section, As we looked at the home buying and process of appreciation in real estate, get to the area of foreclosures, and this is something that is important to look at. So looking at some terminology, we look in the area of foreclosures. This is an important topic that's in the comp plan. I'm looking at Zillow.com, some of the definitions that are there, but a home buyer really is a person that's borrowing money to occupy a structure. They honestly don't have own the home. They're in and occupying the structure as an asset. Is looking at foreclosure is a legal process by which the borrower forfeits all rights for the property. If a buyer can't pay off the outstanding debt or sell the property via short sale, the property then goes into a foreclosure auction. If the property doesn't sell there, the lending institution takes possession of it. So that's really the overall view of foreclosure and what's happening in our city, but also other cities around the U.S. So I just wanted to provide an overview of the foreclosure process. Again, I'm not an expert in this, but this is what, as I've known people that have gone through it and known process and researching it. If you need help in this is something that you can dig into with some of the notes. Stage 1 is the missed payments that happen, not able to meet the mortgage payments. The stage 2 is the public notice. 60 days after the notice, then there's a notice of default that happens. In stage 3, we've got pre-foreclosure. We got 30 days to pay off with penalties included, and there's penalties that may be through all this depending on the lending agency and the mortgage that you have, reading the fine print. The short sale is getting the lender sale property for less than a value. The stage 4 is auction, is foreclosure auction or notice of trustees sale. It depends on what state you're at, NTS. The right of redemption is the borrower can pay off the debt. There's always up until the last second that the borrower can pay off the debt. So in the last stage, stage 5, post foreclosure, if the property isn't sold at auction, then it becomes a bank-owned property, and the bank may go and look at liquidation to try to get some of the value back out of that property. So the thing to look at this is just a snapshot from Realty Track. In short, and all this, take all notices seriously. If you have property, hey, even if you're a renter and any notices come up, take notice of the notices. Sometimes we look at underwater, upside down, or negative equity. We hear this terms, the borrower owns more than the value of the property. So the mortgages and what's owed is way more than the house itself or property itself. The section in this real estate area, building statistics, looks at absentee landlords. Through the public engagement meetings, that was a huge concern. So in the comp plan stated here, a primary concern voiced by city residents is the behavior of absentee landlords. While some absentee landlords are good building managers, many have a reputation for exploiting deteriorating real estate, leading to the complete deterioration, abandonment, and condemnation of building stock. So this is what happens is the value. If it's an absentee landlord, they're only in it for the money, because if they weren't, they would be doing stuff to understand the relationship of the social and the place. So the people in place is important, not just the economics. So this is where I really look at that triple bottom line, is it shows here when you look at the buildings where the disinvestments happened. And there's this breakdown in understanding. We're just using the property as a way to benefit our own pocket rather than, and using others and using the community rather than reinvesting and building from within. The comp plan continues. Poorly managed properties generate high levels of undesirable behavior and crime. Repeatedly, the citizens complain about the one building on that block that creates problems of health, safety, and welfare, as well as suppressing property value for the block within the city's neighborhood. So this is something that needs to be looked at, and this is happening all across the Harrisburg city, is that we understand these properties, and this neglect is continuing to impact the local community at the block level. So we should be really understanding, listening to our residents and those who live and work here and contribute to the city and want to see it succeed. We should be really listening to those residents. That's I think the fundamental piece on all this is be listening and being connected to your neighbors. So the comp plan lists a couple of items to look out for absentee landlords. When you see they tend to reinvest in their properties at low levels below the threshold of sustainable building maintenance, choosing to do poor construction, poor materials, and just doing quick fixes. So this is something that's just a short-term fix rather than a long-term affecting someone's life living in that and occupying that space and that renting that apartment or living in that house. They often pass through a portion of the savings from deferred maintenance to their tenants in the form of lower rent. So this is also something where, it's going to cost money to fix something up. So I'm not going to spend a lot so I can keep your rents low. Again, the cycle depresses rents for the surrounding neighborhoods below sustainable building maintenance, while it transforms single-family houses into rooming houses. So trying to understand the need to house folks in the city. Importantly, the absentee landlord model would not work if there was not a strong market for very inexpensive housing. The city needs to develop policies and facilities to safely and affordably house this population. So we want to look at this housing affordability, look at it, and I know the city's already gone and started to do the task force with housing task force. More needs to be done in this, and more needs to be engaged in the neighborhoods itself. I think there's a lot of data that could be by talking with residents and looking at neighborhood surveys to see where people are and understanding who can afford some of these houses and what they're looking for. And that's an issue now when you look at the nation. A majority of people are now just renting because we can't afford the houses that are here. So this is part of the problem looking at long-term home ownership. Again, continuing on this, creating desirable alternatives to absentee landlord rooming houses is the first step in eliminating the type. There are many very successful examples of single room occupancy, the SRO facilities built in cities around the country. I must say that there's a side note on that, and that's also been looked at in how that dynamic's changing, particularly in New York, San Francisco, and other parts of California. So this is something that should be studied as well, but we need to have a greater mix beyond the single family house. That's really the key piece in housing that we continue to return back to. So thanks again for listening. The next segment will be looking at real estate taxes and wrapping up this portion of building statistics.